We were talking about mutual funds, and we'll continue to talk about mutual funds, stocks, the rest of that. Everything's related. Um, you know, for the most part, mutual funds are just comprised of various stock items. Um, you've got, well, here they're just showing an example of tax implications from a mutual fund where there could be some dividends in the mix and there could be some capital gains in the mix. So again, two ways to make money from stocks. One is, buy low, sell high. So that is a capital gains play. That's where I tend to do just about all of that. That's because the other way is to make it in dividends. Dividends are more of a slow and steady process and based upon income. But you would not expect most companies that are paying dividends to have, you know, big movements in terms of price because they're usually fairly steady companies. And in my mind, a lot of those companies, they end up being like Sears or IBM or Xerox or something, and they sort of fail to adapt. So I don't necessarily see those as the most solid companies anyway. Some of the biggest market capitalizations now are, you get companies like Alphabet that owns Google and all the rest of that, and Apple and Amazon. So things have changed over the years. Right now, there's all this volatility right now. When you've got the midterms a week away, it would be fun to try and make some money in this market right now, but because of the volatility, you could perhaps do some timing, but it'd be pure speculation. And trying to figure out these people is exceedingly difficult. You see just some really silly things going on, both in the political world and also in the financial world, and to try and make sense of it right now would be difficult in terms of investing. I would think speculators might be able to do some good, but when you're looking at a company, and I'll show some examples here in a while, but when we say a stock is volatile, that means that the price goes up and down quite a bit. And if we're in it for the long haul, so be it. Let it be volatile because we're more concerned where it's going to end up 5 years down the road, whatever number of years down the road. I invest in a lot of small stuff, and I really don't sweat the ins and outs. I have some alerts set if I have something I want to sell, for example. But other than that, I don't fret over it day to day. You pick good companies and you stick with them, and that's kind of how it works. And risk investing in a mutual fund, it's the risk of investing in stocks. It's only as good as the companies underneath it. Now, you can have some diversity by buying a bunch of, by buying a mutual fund where they have a whole bunch of different holdings, but that's fairly sound logic that not all of the industries are going to go down at once. Consumers are still going to need things, but if it's a specific sector, for example, technology's taking a beating. A lot of that has to do with some ties to China and also being perhaps a bit overvalued a while ago, but it can get involved. But anyway, there's some market risk, and then there's also there's inflation risk and other things like that. Trade-off between expected risk and return of stock funds. So any investment, the reason why you're getting a huge yield is because you're taking huge risk. The reason why you're getting a low yield is probably because you're taking very little, if any, risk. So you got to find a balance. It's like that with everything in life. If you're getting in excess of say 10%, in return, you're probably experiencing a fair amount of risk. And so don't be surprised if things go south. But, so pursuing, get rich quick schemes is not really a sound principle, but just as unsound is putting money in a savings account and having the buying power being eaten away by inflation. So you've got to use some judgment along the way. Moderate growth fund. Okay, again, it's all marketing. One man's moderate is another man's whatever. It's and then a high risk is going to be a growth stock fund in one sector, one specific sector. You are picking that this one is going to take off. Yeah, so you kind of got all your eggs in one basket. But in terms of growth stocks, maybe a growth stock that's spread across a variety of sectors, you can find one of those, and that might be more suitable for you. The measure of volatility, because, it's like somebody saying, well, saying that the sea is volatile. Well, the sea goes up and down, right? And if you're measuring, the volatility of the sea compared to a dock, you can't really make valid comparisons. All you can compare is from a fixed point to the ocean that's constantly moving. If you say your boat is very volatile compared to the sea, well, that would mean your boat bounces around a little bit more than the sea does. And so that's how they measure volatility. They use a concept that the factor is called beta, right? Beta, if somebody says a stock has a beta of a certain number, that's what they're doing, is referring to the volatility. And the way they make this a valid measurement is they actually, equate this to the tide that's going up and down. They pick something else that's moving up and down with the stock market. They pick the Standard & Poor's 500. The index of the Standard & Poor's 500 is a beta of 1 by definition, right? So it's just arbitrary, but they pick the Standard & Poor's 500.
Where is it in your slides, this beta? This is the second time we talked about this beta thing, and it's not been in the slides.
Yeah, it'll be in here, but it just kind of came up in terms of volatility. But anyway, so if you have something that's like, say, a 0.5 beta, that means it's half as volatile as the Standard & Poor's 500. If it's a beta of 2, that means it's twice as volatile. So just something that comes up. Here's some more mutual fund type stuff, just different classes again. An index fund. Okay, from an index fund, we know that that's just a buy and hold position. They would buy, say, one share of every one of the 500 stocks against the Standard & Poor's 500, and then they would call that a Standard & Poor's index fund. They're not buying and selling. They're not going to decrease their holdings amongst different companies. They're going to keep it absolutely equal. They're going to have an equal representation of each one of those companies across the Standard & Poor's or the Dow Jones or whichever one they want, and they're going to call that such and such index fund. I mean, a computer, a monkey could do this. This is not difficult. It's a buy and hold position. They don't do any movement. Income fund is one that's going to pay dividends primarily. The income's derived from dividends. Now, that doesn't mean that the other ones don't make money. It just means that the money is made on those by capital gains. And then balanced growth and income fund, something that's got some growth stocks and some income stocks. Growth stocks. Capital appreciation means that you're buy high, sell low. There's no expectation of a dividend. Global stock fund. A global stock fund would be one that's going to can have stocks from anyone, any nation out there. Technology, primarily in technology. I mean, we could go on and on. It's all marketing. It's however you want to sell it. Foreign stock or an international fund would be one that's on foreign countries. It could be, in this case, focused on one small country. You can do that. Or you can go across a region. You can do, BRICS, Brazil, and the other countries, India, Russia, that are under that title. Mutual funds according to, low, medium risk. In the different bond funds, the reason why they're showing difference in risk amongst those funds is the longer term ones are going to incorporate more risk because you're making a forecast on interest rates further into the future, which is more risky. You're saying that I'm going to take this bond fund and be committed to it for 5 years, not knowing exactly where the interest rates are going to be 5 years from now. If it's say a 3 month, a short-term bond, well, interest rates aren't going to double overnight, not going to double in 3 months, so there's less risk involved. So that goes with all those term kind of funds, the Ginnie Mae's, the mortgage-backed securities, same way, corporate bond funds, same way, and the junk bonds down on the end. Again, you can see now they're using high yield. So high yield and junk bond are synonymous. Don't fool yourself. I mean, they're speculative bets. You might want to jump into them at a certain point, but don't be fooled by going, oh, I want high yield. That sounds good. Well, it also implies high risk. More about mutual funds. So we just hit that about the longer you're committed to a fund, the higher the risk is going to be. Conservative bonds, moderate, and then a high risk. As long as things, this was the mismatch in 2007, like I said. 2007, 2008. There were things that were, if they had been evaluated properly, they would have definitely been in the high risk category. But because people lost track of what the underlying securities were, they were classified as low risk. And so people got clobbered and said, oh, how did this happen? It took two to do it. It was the government, it was the private sector. But they did it to one another. I mean, the banks were making money, and the government, the politicians were making loans to everybody. Home ownership was a realistic possibility for everybody, when it probably shouldn't have been. These people didn't have the finances to pay for their houses. And, who got burned in the end? Not the politicians, the poor people holding the loans. Trade-off. What's that?
I heard you said something about politicians, and I missed.
Oh, the politicians survived. They didn't blame anybody. And nobody from Wall Street went to jail. But the people with the crappy mortgages, they ended up losing their homes or whatever. But yeah, to date, I don't think there's been a single banker go to jail. But in the neighboring cell should have been the politicians who were, encouraging people to make loans. I mean, banks were literally being forced to make loans that they normally would not have done. There are all sorts of rules about, well, the reason why there aren't enough loans here is based upon some sort of, prejudicial whatever. So you better start making loans there. Well, the reason we don't make loans there is because we have a high default rate in certain neighborhoods. Well, make the loans. There you go. And that's how we ended up in it. So it takes two to make that large a mess. Selecting a mutual fund. So we're going to look at this in depth. Investment objectives, though, it ought to be long term, for retirement stuff. And again, I stress, save for retirement, but probably use it for other things in the interim. All these things are long term plays, but there are benefits to you by having a long term, nest egg of wealth built up. Evaluate risk tolerance. Like I say, there is no avoiding risk, Now, accepting stupid amounts of risk is obviously stupid, but thinking that you're going to accept some non-risk strategy is equally as flawed. I'm not trying to be a doomsday person here, but, there's all you have to do is check the news once in a while, and you can see just some of the stats out there. The number of people who have not saved for retirement. The number of people who they can't come up with $400 to meet an emergency. There's a lot of people under financial pressure, and it's going to get a lot worse. Because this generation, just how many people do you know where grandparents are taking care of children, and the parents are unable to when those people who are that intermediate generation become the grandparents, they're not suddenly going to get a bunch of wealth. That buffer that the sort of the baby boomer generation provided is not going to exist this next go round, and it's going to be it could get a little ugly. So anyway, how does that get back to mutual funds? It just gets back to retirement planning in general. but evaluate your risk tolerance. I'm not saying to do any get rich or any kind of speculation, and make sure what you do is in line with your tolerance. If the market falls apart and you're going to be one of these people who's going to panic and sell at the bottom, that's not a good strategy either. And if you're one of those people, then I don't know what you're going to do, but probably being in the market is not going to work for you. Decide on the fund characteristics desired, and then find a fund that matches those. And then the prospectus. So I talked about the prospectus before. This prospectus are the rules of the road. If you want to know, not just when you get beyond the glossy, brochure or the fancy web page or whatever, you need to read the prospectus. And you are going to check that you've read the prospectus before you can invest in that fund. Now, you can do it like an end user license agreement, on software, and just click it and accept and move on. But you really should not do that in this case, at least not the initial paragraphs, because the initial paragraphs are going to tell exactly what the person, or the fund team is going to try and do, how they're going to try and make money. And if you think, well, I want to get involved in this fund because they're going to, invest in these foreign countries, and they're going to, their primary goal is to stay away from speculation and do this, it should say that right up front in the prospectus. If it doesn't, then they're not bound by it. It essentially ties the hands of the person who's going to do the investment. Investment objective. So, investment strategy and performance. So performance, again, when they're talking performance, a lot of times they'll compare it to the S&P, which would probably be an index fund in that case. But the Standard & Poor's 500. The Standard & Poor's 500 or any of these other indices, there's nothing magical about them. But again, if you want a measurement, kind of a yardstick out there, you need something that's out there that's floating around that is going to provide a measurement. When you say a fund did great, well, as compared to cash, let's hope so. But if the whole market went up and your fund didn't go up as far as the S&P in this case, well, maybe you should be looking for a different fund. You're looking for something that outperforms the average, all things being equal. The other thing is, too, that, past performance, stocks, prices, and all that, and that's what mutual funds are based upon, is typically stocks. There'll always be a thing in there, past performance does not indicate future performance, some quick language in there to basically say that, although the past is important, it's not completely indicative of what's going on. And this is where common sense comes into line. This is where somebody like Warren Buffett, has some intuition. When he took a big position in the trains, the CSX people, somebody who's looking at past performance, looking at all the financial data would go, trains look kind of boring. But it was him putting it all together going, wait a minute, fracking is taking off. There's a ton of oil being produced. There's no pipelines on the horizon. The only way to move this oil is going to be a train, and I'm going to make a killing on that. That would not be apparent in past performance. It would not be apparent by looking at the financials. It might be labeled in their annual report. But again, the guy who signs off on that annual report, if he puts a bunch of fluff in there, he can go to jail. He's got to legitimize it. That's why Elon Musk is in a little bit of trouble now, because he made some comments on, what was it, Twitter or whatever else, about selling the company. And, you start manipulating. It's all fun and games till somebody loses a fortune of money, and then they want to sue you. And they can, because you signed as the corporate officer. So, there's, plus those guys getting the information from a company report, it's going to be a bit editorialized. You're better off looking for a third party. Fees and expenses. So, again, if it's a, loaded fund, you kind of knew what you're doing there. I would, loaded fund has a commission coming in. I would not necessarily do that. I don't see any reason to do that. Redemption fee or back-end load, those are fees charged when you sell the stock or sell the mutual fund. if I'm going to have to pay a fee, I'd rather pay it on the back end, because that way, they have some skin in the game. If I lose all my money, well, guess what? They lost all their commission. But it's still, I don't have anything that I've ever paid a back end fee, and I've never paid a front fee, a loaded fund, because no load funds are available. Expenses, including management fees. These can vary widely, and this is what will be identified in, say, a Morningstar report or something like that. But if you're looking at an index fund, something that's, again, they just buy and hold, those fees are going to be super low. The expenses are going to be super low. Doesn't take some high-priced management. It doesn't generate a bunch of commissions. Doesn't generate a lot of work for anybody. And so that's one way to do it. The risk, yep. Again, it's going to be proportional to what's going on. But again, you can use a thing like Morningstar to help you out. And then the distributions of dividends and capital gains. When you're typically filling out the form, my advice to you for the most part would be, there'll be a block on there, say, reinvest all dividends, reinvest all capital gains. So if they sell some shares throughout the course of the year, rather than them write you little checks and all that kind of stuff, if they just reinvest that money, it just makes your fund grow, and it minimizes those small transactions. Minimum investment, minimum balance, not a big deal, especially if you go with a company and you set up with some sort of automatic debit program. It'll usually be quite low. How to redeem shares, dead easy. Back in the day, most of it was done by phone, when that was the modern way of doing it. Before that, obviously, it was paper. But now it's online. My caution to you for most of the stuff, though, is rather than, because the trend was to make things easier and easier to redeem and transfer around. Now with identity stuff, I'm more concerned. I still want the flexibility and the convenience of being able to redeem shares, but I'd probably want to see what they got as far as two-party authentication. So some sort of mechanism. Two-party authentication. Whereas if you want to sell something or do something, they send you a text with the code, you got to type it in, or you got to do the Google Authenticate, or like my bank in Germany, they have a photo, it's this random thing. I scan it with my phone, it gives me a whatever digit code, I type that in. There's a lot of security that is necessary these days. Consider the following. So anyway, they're kind of telling you how to buy mutual funds, how to look at this. It's quite easy. They're okay. The other page, they talked about Vanguard. Now they're talking about Fidelity. We're going to go to these sites here in a few minutes, and I'll show you a little bit. Yeah, any one of them. It's dead easy. And like I say, since mutual funds are denominated in dollars and not shares, it's super easy. You can say, I want to buy $50 a month, and that's not a problem. $50 a month, deduct on the first, pay myself first, and then when I start making more money, I'm going to up and up it. I'm going to start out with, say, 10% of my salary, so hopefully we're more than $50, and then you just keep ratcheting it up once a year and make the adjustment, and next thing you know, wow, you got a big chunk of money. It's especially if you do the whole pay yourself first thing, and just make it a bill. Just take care of it and don't stress about it, and move on. Quotes from funds. So yeah, this thing in there, NAV, net asset value. All that means is that they calculate all the math from all the underlying shares, the total value of that they have within the fund, and then divide that the number of folks out there with shares, and that gives them a number. So it comes up and it looks a lot like a stock price. The other caution on this too is I would be careful to, if you think you've got some diversity by having different mutual funds, and part of that prospectus, it will tell you at the time, because it's kind of a snapshot, because the guy can buy and sell funds under that account, but see what their largest holdings are in. And like I say, if it's a growth fund, it's probably going to be loaded up with, Alphabet and Amazon and stuff like that. So you may think you have diversity because you've got, Bob's fund and Jim's fund and whatever fund, but you look underlying stocks, they're all holding the same stuff. They're all taking the same bets. So we can do better than tabular data. We'll show a chart here in a second. Dividend, last price, net change. But again, if you're looking in a newspaper, it's old information by then. Cracks me up on the radio. You ever listen to AM radio here? They'll do the weather report, and it's like information from. They have the technology. When I was overseas, they would literally read the stars and stripes. They would take the print newspaper and basically put it into a digital format. It was garbage. So make sure you're looking at current information. Mutual fund evaluation, or the mutual fund, whatever, these guys, the MFEA, they're all right. They're funded by the mutual fund companies. I would rather jump to Morningstar. Diversification among mutual funds. Again, be aware of false diversity. But you can definitely, you can. Fidelity, for example, I had a whole bunch of different products of them after the election. I put in like when the defense won, because obviously there was going to be a lot of military spending. I went with some biotech stuff, figuring that they were finally going to sort out the healthcare situation. That didn't quite work out, but that was some of the criteria I used in more of it was investing, but there was a bit of speculation in terms of thinking what was going to pop ahead. A general growth fund probably would have done me better. Impact of the financial crisis. Yeah, and even overseas. People go, well, the U.S. economy may be failing, so, I'm going to invest overseas. Guess what? When the U.S. coughs, the world gets a cold, or however that expression goes. When markets go down, they all kind of go down together. So, and even amongst investments, I talked before about precious metals, where there's so many industrial uses for gold and silver and some of those other metals that when industrial production goes down, people think, well, I've got my money in a hedge. I've got precious metals. So when the market goes down, the precious metals are going to stay up. Guess what? The demand for precious metals often goes down together. And the same with countries. Germany, Japan, who buys all their cars, all their stuff? We do. And poor China, they've got a situation because of the population. If the factories don't keep chugging out stuff, they've got to, things get ugly in a hurry. So there's a lot of global linkage amongst the different markets that definitely exist. I'm not making opinions on the situation in Brazil, but Brazil is Bolsonaro. I don't know if you know this guy, but he was just elected in there. That's going to be a radical change in Brazil. So that would be something. If I was looking at an international fund right now, I would say I'd invest in Brazil right now, but I definitely want to look at that and see which way I think that's going to go, because it's going to go one direction. I guarantee you. It's a big change down there. Diversification through mutual fund supermarkets. Yep. So these companies are trying to make things easy for you. In fact, what we haven't talked about so much in here, but there will be a slide, I promise, later on, regarding life cycle funds. A lot of people will, not a lot of people, but a lot of investment advisors will say, okay, so what you need to do, just like I'm saying, when you're younger, you need to be involved in growth funds and more aggressive funds, right? And as you get older, you want to get more moderate funds. And as you get, close to retirement age, you want to be into income kind of funds. They're going to be paying a dividend. And that's how you should go through life. So anyway, what these mutual fund companies done, they'll have different names, but they'll call it, Life Cycle 2050. And that's like something that one of you all might invest in a little while, and it's a target date of 2050 for your retirement. If you got to retire that early. Maybe that's a little bit. Anyway, whatever date kind of corresponds to your retirement. And this mutual fund is going to be really heavy in growth stuff when you're young. Mid-career, it's going to be changing, and then end of your career, it's going to be in more income stuff. It's I wouldn't say it's a gimmick, but it's not something I do. That was the default position when I signed up with the company. They're like, oh, okay, when's your prospective retirement date? This is the fund you want to be in. I'm like, yeah, thank you very little. I took my money back aside. What I've done with mine, it's kind of funny. They've got a fund where you contribute and there's a match. So like I say, if there's a match, you want to definitely do it. So I put up 4%, they put up 6%, right? So it ends up being 10% of the sale. But anyway, it goes into a company, and it's another company. This one's called Voya, a Dutch company, which I really don't care for because I just don't like the way their site's set up and the way they do stuff. And their funds are not huge performers. But you're going to be working for this company, you're going to be investing with this other company that they've chosen. You're stuck with this condition of employment. So anyway, you get in this mutual fund, and what I've done is, number one, I got away from the life cycle stuff and I put it in the more aggressive. It's like the Russell 500, some other index fund. And then the other half, you can do up to 50% of your income into, or 50% of your contributions can go into what they call a self-directed IRA, where you can actually put it in a brokerage account and buy individual stocks. So I've been doing this for a few years, and the amount of money I contribute, I went and I put 50% of my self-directed one and bought a bunch of tech stocks and a bunch of growth stocks. Well, I can no longer put any more money into that self-directed one because it exceeds their fund. They were 50-50 at first. Now this other one, the self-directed one's like at 60%. Even though I'm contributing 10% of my salary to this other account with their lame mutual fund, it will not keep up with my individual investments. You know what I mean? So, I mean, in my mind, you can outperform these guys because I think they just take too conservative of an approach. But not all mutual funds are the same. But when you're working for a company, sometimes your hands are tied. And the only way you can switch to a different company is switch to a different mutual fund company. If it's one they've chosen, is by quitting that company. Actually, anyway, it's long stories there, but when they're making a contribution and it's, they view it as their retirement plan, you got a problem. There's also a concept too that I'll talk about right now. It's called vesting. Okay, let's say you go to work for a company and they say, guess what? We're going to put, the same scheme. We're going to match your contributions. You put down 4, we'll put in 6. But there is a vesting process, which means if you quit in the first year, we take back our match. The only thing in that account is that 4% you put in. At the end of 2 years, you get 50% of what we put in as a match. Your contribution is always going to be your contribution. But that part that they're matching with is an enticement to keep you with part of the company so you don't just, take the money and run. They will use a vesting scheme, typically. And so then a typical thing is at the end of 3 years, 5 years, okay, regardless of what you do, you get to keep all of your match. So that's quite typical. First case in a bunch of mutual funds. Yep. Again, they're just picking a random selection. The other thing I would say in here is that Canadian thing. Canada is a wild west when it comes to investing. It's just a different world. The way, I guess it has to do mainly with their mining stocks and stuff. But you just see some wild things. You go, oh, Canada, that boring country up to the north or up to the south or down to the south from this perspective. Their stock market, especially in their mining sector, is crazy volatile. I don't invest in it. Some of these other ones, though, you might see some room to go. Hedge funds kind of go beyond what we're talking about. Hedge funds are speculative. These are guys that are, using borrowed money to do stuff, or they're taking huge positions, or, they're doing short sales. Or when Elon Musk is on, Joe Rogan, These are the guys that are going, we're going to be a contrarian. We're going to sell short, and we're taking options. We're buying. They're just doing crazy stuff. Sometimes they make a killing, but sometimes not. And especially in the futures and options market, unlike the stock market, in the stock market, everybody can win at the same time. The market goes up, everybody wins, right? In the futures market, for every winner, there's a loser. That's just the way it works. It's a zero-sum game in futures and options. And so, to think that I'm going to beat a professional investor, I'd rather be in the cart and, the rising tide raises all boats principle rather than thinking I've got more intuition than a professional investor. Madoff, yeah, so like I said, that last thing, investors should have been suspicious. Don't worry, these yields are going to continue. Well, why can't I have access to my cash? How am I getting this much? How is everybody else? The regular market's going up by 10%, but yet I'm getting like 20% yields? How do you do it? They never asked those kind of questions. They just wrote it off as this guy's, a magician. And yeah, obviously he wasn't. And then the homework. So I think I need to do that in an example for you, because this is that same one that you've been not screaming about, but asking to see the example of, in terms of applying a taxable versus a non-taxable. It's not that hard. All you'd have to do in this case is know what your tax rate is, and let's say it's 28%. Okay, we can do this in our head. 28% is your tax rate. That's how much of any money you make, that's how much the government's going to take, right? If they're going to take 28%, what's that going to leave for you? 72%, right? By definition. 28% minus 100% is 72%. So all you have to do is multiply that 72% in this case by whatever that interest rate is, that untaxed interest rate, so that 10.2%. And I don't know exactly, but I think it's going to be about 7.3, right? 10.2 by 72. Anyway, and so it's certainly not going to be 7.9. So just in your head, you can go, I'll take the 7.9. That's whatever. But the thing is, you're not going to see the sort of disparity in the numbers. You're going to do the math, and you're going to go, oh, guess what? It's about the same as the other one. Probably the mutual or the municipal bond is probably actually going to be a little less of a yield, because people tend to gravitate. They hear tax-free and they think, oh, this is a win-win scenario. But if you're a high-tax individual, if you're a one percenter, and let's say you live in California, your combined tax take is like 63%, well, then this whole equation gets completely skewed, But if you're somebody who's just squeaking by, you're down in the lower thing where you're not really paying much in the way of income tax at all, then giddy up, take the taxable, because you're not paying much in the way of taxes anyway. So, you purchase the shares. Yep, they paid a commission. Obviously, the commission is going to come off the top. You shouldn't have paid a commission of $50 would be my main argument. $4.95 is what it's going for. Maybe under $10 certainly. But you can do the math on that one. If interest rates in the overall economy decrease, what will happen to a corporate bond? So, again, this is not the situation we're faced with right now in current politics, current economic situation. Interest rates in the overall economy decrease. When you're down pretty darn low, it's tough for them to go any lower. So the more likely scenario is interest rates increase. But anyway, for the sake of this problem, interest rates decrease. What will happen to market value of a corporate bond with a fixed interest rate? Well, your fixed interest rate is going to be more attractive. The value of it's going to go up. You could sell your $20,000 bond for $21,000, or you can sit there and just take your 5% interest in the new bonds are being issued at 4%. It's a advantageous position. But that's what I'm saying. That's not the world we live in right now. Right now we've got low interest rates, and when interest rates go up, your bond is undesirable, and so are the interest rates that you're going to be getting with it. This one, $250 a month because the interest rates, current dollar value, how much the investments. Anyway, that's just a simple math problem as well. So what we're going to do now, though, is I'm going to look at I've just got a few of the websites pulled up. Now, first off, this is why I'm saying tab data is kind of garbage. This is just Yahoo Finance, nothing special. NVIDIA is a company I own. They did real well because they've got a lot of processing power on their graphics cards, and the Bitcoin guys were using that for mining Bitcoin. So there's a big bump a couple years ago, and that's why it's kind of dropped, not out of favor, but it doesn't have the explosive growth that it had before. But anyway, the thing about this chart is it's completely interactive. So it gives me so much more information than the other one. Let me take this down a notch so you can actually see it on the whole screen. There we go. Okay, so as I move, my mouse across, I get an interactive display, and what it's going to do, it's going to give me the price up there on the right side, and it's going to give me the day down on the bottom. So that's the actual price going up and down, this blue line ticking along there. And then these numbers on the bottom are the volume, so I can tell, how much is being bought and sold. But the most important thing is this time frame thing. So 1 day, 5 days, 1 month, 3 months. They usually default to a fairly recent, fairly short time frame. But what I'm kind of interested in is probably, 2 years, 5 years. So you can see, I think this was mainly caused, part of this was the tech sell-off, but sort of the leveling was also caused by the not undesirability of Bitcoin, but it not being quite as fashionable as it was. Let's look at another company, Shopify. Again, these are individual stocks. These are not mutual funds, but again, performance is, and the other thing you got to look at, this one is not logarithmic, but you got to look at the scale on the side. I like this one because it's cleaner. It's a linear progression, 25, 50, 75. Sometimes you'll see the numbers squished together, and it just distorts the depiction. But back in here, the price was about 28 bucks. And in here, it's 132, so that's 500%. Anyway, if you're somebody in it for the long term, it's not bad. Anybody else got a company in mind? No? We can talk about how to find companies if you're going to do individual stocks. Obviously, Yahoo is going to be kind of annoying here with all their ads coming up continually. So we'll move on from that. In terms of investment companies, you can type in Fidelity, you can type in Ameritrade, you can type in whatever company you want. If you already have an account, obviously you're good to go. Open an account, easily done. Planning and advice. If you want to, you're preparing your term paper and you want to do something on financial, retirement planning, something like that, you can just jump directly to their site, and it'll give you their actual products. But actually in here in the retirement, it will come up, just with some philosophy things, how to do it, approach your retirement, just more information than we can go into in detail here in class. And then you can go, pick one of these. And I'm not saying you have to establish an account with any one of these guys, but you can get a lot of information from these sites. And a lot of times you can get some of the calculators and stuff that might be useful in putting into your chart. TD Ameritrade. So what happened was Ameritrade's been out there for years. Scottrade was one of the low discount brokerages. They merged, so now they're one of the bigger players. I've got an account with TD Ameritrade. The one advantage of these guys is that they actually have a local office, so you can actually walk in there if you want. They don't really do much for you, but if you've got a check or something like that and you want to deposit it, they might offer you some sort of advice. I don't take advantage of it, but I do, like the fact that they've got a branch if I needed to go in there. But again, they're going to have the same sorts of sections, and they will also have sort of mutual fund and investment selection processes. So, they've got the full gamut. When they talk about you have to go to this place to get that type of fund, that with a big brokerage house, I mean, you can pay your bills from these accounts. You can have checking accounts with them, just for simplicity. A lot of ways to do it. What I would typically do, like I say, I'm associated with this Voya company that I'd really rather not, but I can't get my money out of there because that's what the company is associated with. If I was working for a firm, and you already have a 401 or something established with, Charles Schwab or somebody like that, there's probably not that big a difference between the individual companies. And for simplicity, you might also want to have your personal investing that goes beyond what your company is doing with that same company, just to minimize the, paper storm that's going to occur when you go to do taxes at the end of the year. But that's up to you. Mutual fund investing, explore mutual fund investing. So these guys, they'll be able to sell you not only what they have, but also some. It's like going to, Fred Meyer's. Obviously, they're going to have the Kroger stuff. They're going to have their house branded stuff, and then they're going to have the national brands that you're used to. These guys are the same way. You can buy pretty much whatever mutual fund you want. They're going to have some of their own branded stuff, and then they're going to have some of the other products. Selecting a mutual fund research. Now, if you actually have an account with these folks, then what I would do is Morningstar, because Morningstar is not affiliated with this company. Obviously, they have some marketing affiliation, but Morningstar's advice is from Morningstar directly. They are not, they don't have skin in the game. Their reputation exists based upon, the advice that they give. They don't sell stuff. So if you want to get access to Morningstar stuff, though, you're going to have an account. They're whatever they're calling it, their premier list. They're going to give a little bit of information in here, but again, I realize this is a bit of an eye chart. It might take a bit more information. One thing too that I get, as you guys get to read my personal emails here, not that much exciting, but Motley Fool is something I've dealt with. Motley Fool is again, almost like a Morningstar kind of thing, but they are offer advice on stocks. It's a subscription service, so I got to pay for it. Not a big deal, it might be a couple $100 a month. So once you get some money together, but they come through with, companies. I've got Tencent. It's a Chinese internet company, again, but they go through in kind of layman's terms, give you the information. It's listed. They've got different products. Motley Fool does, one of which is called Rule Breakers. It used to be called Hidden Gems. Anyway, these are definitely small caps, almost in the realm of speculative. So I'm kind of in a different position because I've got a lot of investment in real estate type stuff. And so in the stocks, I tend to be more aggressive to balance out the real estate, which is pretty darn conservative. But anyway, they go back and they first recommended it. Well, actually, in October. So again, it gives you the information. They show when they recommended it previously. They give some data what the cost is. The return, it's not really doing so well. It's down 25%, but it's S&P is up 10.4%. So that means that relative to the S&P, it is down by about a third. So why are they recommending it? They obviously must expect things to go a different direction. So anyway, they'll go through, most of their stuff. The Chinese stuff right now, obviously with a looming trade war and a lot of rhetoric going back and forth, things have been a little rocky, but whatever, I'm in it for the long haul. I don't want to lose money, but they make their argument why they think it makes sense. Now, some of these companies, that you can't reach out and touch using kind of the Warren Buffett principle, I would not invest in them at all. But this one, you read through Chinese internet, sounds logical, their recommendation makes sense. You can also do a little bit more due diligence by looking at their financials, see if it's relevant to you. And then if you want, you go ahead and pull the trigger on it. But you don't buy through these guys. These guys do not sell. They'll make recommendations, but they don't actually offer it. Alibaba, I don't know if you guys are familiar with that. It's sort of like eBay, but bigger. They also will do this disclosure down at the bottom of the authors to tell you what their positions are, what they own, what they don't own, what factors may bias their advice. So anyway, that's just something I would use. If you're getting more serious about it, if you're doing mutual funds, you probably don't need to go this far. You probably might just want to go with Morningstar, get an overall recommendation, look at past performance, temper that with some intuition in terms of what you think is going to do well, and then move on. Yes?
So I was looking at this mutual pool and
Motley Fool?
Motley Fool, and would you think this is something that has like a Bloomberg setup would be looking at?
Well, Bloomberg, I think a lot of those guys, anybody know who Kramer is on financial stuff? The reason I bought Twitter is because Kramer's like, this is an idiotic stock. Nobody can price it. Bloomberg, if I was looking at buying GM and a bunch of, established companies, I might be more inclined to go with a Bloomberg kind of thing because they're more conservative and they're more based on traditional finance kind of issues. But for emerging markets and small caps and stuff, I tend to go more with the Motley Fool because I think they're more in tune with it. The Motley Fool too thing, they're kind of their shtick is that it's not that serious, that they don't get that wrapped up in the details. They're more about, I don't know, it's more of a touchy-feely. Let's have fun. Let's not take it too seriously. We can all get rich, but we don't have to bury ourselves in a bunch of boring, details. We're looking for, and again, evaluate these guys just the same way as your stocks. You go back and you look at, okay, who's this, Goomba who's making the recommendations? What's his past performance? How's he done? What's this guy's track record? The person who's making the recommendations. And you can step through here and see, yeah, who's making money, who's not. Axion, I've got these guys. They make tasers. They make the body cameras. I mean, that was kind of a no-brainer. With all the stuff going on with the cops and stuff, more insistence on people having body cameras. The folks who make tasers, number one, they make that, a non-lethal kind of weapon, but they also were big into the body cameras. I was a bit concerned last week when, I don't know if you guys saw it in the news, but somebody's battery on their body camera blew up, and thankfully the guy took it off, but, Yeah, that's that's going to be a blip in the thing. As long as their products are good, and they fix the battery issue and nobody gets hurt. Yes,
Would full recommendations influence stock prices at all?
they do, and they can. And I'll see their recommendations come out on Thursdays, so you guys are getting this right off the press. But this is kind of a problem when you get a big company making recommendations. When they come out on a buy list, you can generate some buzz. And that's why it's important that those guys disclose what holdings they've got. Because a truly unethical person could do that. They could pick up some, crap penny stock and then make a recommendation, generate a bunch of hype, wait for the stock to go up and then dump it. But again, these guys have been around, I'd say at least 20, 30 years. So they're not going to survive very long by burning their customers, by burning their subscribers. It's, again, like we were talking about with ethical companies and responsible investing. People that take advantage of one another these days, they get dimed out pretty quick. The days of the profitable, unethical companies, I think, are a little bit behind us. I'm hoping.
Named IBM at the beginning of the class as a dividend investment.
What's that?
He named IBM as a dividend investment at the start of the class.
IBM. You don't like IBM?
They basically made the Holocaust possible with their computing system that they sold to Germany.
Huh.
Does anyone still buy them back then?
Yeah. I mean, if I'm not, but I'm just saying that. Oh my gosh. I mean, having lived in Germany, I mean, we couldn't drive Volkswagens. We certainly could not drive. I mean, any Bosch products, any of those guys, there's a lot of bad actors who did a lot, and it's probably still happening, but I don't think it's transparent as it once was. I don't know. So Motley Fool, couple tools though that I use. I mean, if I want to get a quote and I want to look at a chart, I don't go look at a newspaper. I go in here and I look at an interactive thing. And I span this thing around. I look at 2-year, 5-year, year to date. If I look at the max, now I know how long the company's been in business, what the ups and downs are. It's just a lot more powerful than tabular data. And Yahoo doesn't own the interactive chart. They're all out there, but it just pains me when they show, tab data with yesterday's. I mean, that's too little information. You have got the world available to you. If you're looking for recommendations, there's other companies out there. There's newsletters, Bob Brinker and these other folks who offer recommendations. I've just kind of glommed onto this one. I've had decent luck with it. Depends on you. Companies, I'm not endorsing any specific company. They've all got their own stuff, but there's a lot of branding going on out there. So if you're looking for, I want a specific whatever, what are they calling it in their world? It's probably the same sort of product offered, whether they call it a whatever, New Horizons fund. You look underneath and say, oh yeah, okay, this is an international stock fund. They're investing overseas, or whatever, or merging something, maybe a growth fund. So just make sure that it matches to your expectations. And then again, getting back to compiling your term paper. I know a lot of people, they don't like the ambiguity. The fact that I say you can make the term paper tailored to your own needs. People want, no, I wanted a fill in the blank, a checklist. Not so much. There is a checklist in terms of items you got to look at, but in terms of how it's tailored, that's up to you. But the retirement aspects of it, the investing aspects of it, you could go to a prominent website like Fidelity, Vanguard, Ameritrade. Go into their retirement section and find a wealth of information, and they'll tell you about Social Security. They'll tell you about everything else. You can go to Social Security's own website, and they'll tell you, do not, rely on this 100% for your retirement. That's not what we're going to be able to do for you. Do not fool yourself. So It's all about information, and with you all, you can sort that out quite quickly. It's not that hard. All right, we will see you next Tuesday.